If you buy stocks like this, you will eventually lose. Not today, not tomorrow, but slowly, quietly, and then all at once. Most people think stock investing is about finding the right company. It is not. It is about how you behave after you buy. And that is where most investors fail. People buy stocks for the wrong reasons. They buy because prices are going up. They buy because everyone is talking about it. They buy because they are afraid of missing out. That is not investing. That is reacting. And markets punish reaction over time. If your main reason for buying a stock is excitement, you already lost control. Excitement fades, prices move, emotions change. When that happens, your decisions change too. And inconsistent decisions lead to inconsistent results. Most people do not buy stocks with a plan. They buy first. Then they start thinking. That order is backwards. Planning after buying is not planning. It is damage control. If you cannot explain why you bought a stock in one simple sentence, you should not own it. Not a story, not a prediction, a reason. Without a reason, every price move feels personal, and emotional investing is expensive. Another mistake is confusing a good company with a good investment. A company can be great, the stock can still be overpriced. When you ignore price, you ignore risk, and risk does not disappear just because you believe in the business. Many investors say they are long-term, but their behavior is short-term. They panic on red days. They celebrate on green days. They watch prices constantly. That is not long-term investing. That is emotional trading with a slower button. If you check a stock every day, you are training yourself to react, and the market gives you something new to react to every single day. Over time, that pressure breaks discipline. Long-term investing requires boredom, boring decisions, boring holding, boring patience. Most people cannot tolerate boredom, so they create activity, and activity creates mistakes. Another way people lose money is selling for the wrong reasons. They sell because price drops. They sell because news sounds scary. They sell because fear feels urgent. Fear is fast. Logic is slow. Markets reward the slow. Selling should be planned before you buy. If you wait until emotions hit, your exit will be messy. Good investors decide exits in calm moments. Bad investors decide exits in panic. If your plan changes every time price moves, you do not have a plan. You have hope. Hope feels good. But hope does not protect capital. Position size matters more than most people realize. If one stock can ruin your mood, it can ruin your portfolio. Oversized positions turn normal volatility into emotional stress, and stress leads to bad decisions. Diversification is not about owning many stocks. It is about not needing one stock to work. When you depend on one idea, objectivity disappears. The market does not care how confident you feel. It rewards consistency, not conviction, not excitement, just consistency. Here's the truth most people avoid. You do not lose money in stocks because markets are unfair. You lose money because your behavior is inconsistent. Markets expose habits. They do not fix them. If you buy stocks without rules, emotions will create rules for you. And those rules will change at the worst possible time. Successful investors are not smarter. They are calmer. They accept slow progress. They accept boring periods. They accept uncertainty. That acceptance is an edge. If you want to survive in stocks, focus less on predictions. Focus on behavior. Focus on position size. Focus on patience. That is how capital compounds quietly. So remember this. If you buy stocks based on excitement, fear, or urgency, you will eventually lose. If you buy stocks with structure, patience, and discipline, time starts working for you. Do you buy stocks with a plan, or do you react to price? Write your answer in the comments. Like the video if this helped you think clearer. Subscribe for more long-term investing insights.